So you're thinking about selling your home. And in a market like this, you could be looking at a huge payday. I mean, this is it, right? The moment you've been waiting for. But what if I told you a chunk of that profit could come back to haunt you? Not right away, but 2 years down the road in the form of a surprise bill from Medicare. Yeah, really. Let's get into how this whole thing works because it's something you really need to know. For most of us, our house isn't just four walls and a roof. It's our biggest asset, probably. It's that nest egg, that cornerstone of our whole financial plan, especially for retirement. You spend years, decades even, paying down that mortgage, watching the value creep up, all for that moment when you can finally cash in on that hard-earned equity. And when we talk about selling, there's this magic number that's on every homeowner's mind. For married couples filing together, it's a big one, $500,000. That's right, you can make up to $500,000 in profit on your home and not pay a single dime in taxes on it. I mean, that is one of the best tax breaks on the books, period. But here's the million-dollar question, or I guess the $500,000 question. Is that profit truly free and clear of all financial strings? You might dodge the IRS, sure, but there's this financial echo, this ripple effect that most people have no idea is coming their way. All right, so let's quickly go over the basics of this awesome tax break. It's officially called the Home Sale Exclusion Rule. And, well, it's the rule that lets you keep a huge chunk of your pocket. It's actually pretty simple. If your filing is single, you can exclude up to $250,000 of gain. And for married couples filing jointly, you guessed it, that number doubles to that whopping $500,000. But, and this is a big but, what happens if your profit is even bigger than that? Now that is where our story really begins. Now, to qualify for this deal, you just have to meet two pretty basic tests. The first one's the ownership test. Did you own the home for at least 2 out of the last 5 years? Check. The second is the residence test. Was it your main home for at least 2 of those 5 years? Check. For most people who've been in their home for a while, this is a total no-brainer. And listen, this isn't just me talking. This stuff is straight from the horse's mouth. It's all laid out in IRS Publication 523, which is basically the official government playbook for selling your home. Okay, so you've got the tax rules down. Now we get to the really interesting part. The part nobody talks about. We're going to talk about this strange 2-year delay, this financial echo that links the day you sell your home to your bills 2 full years later. Let's just walk through this. Imagine you sell your house in 2024. Pop the champagne, you made a great profit, you file your taxes for that year, everything's good. Then the entire year of 2025 comes and goes. It's not until 2026 that the Social Security Administration takes a peek back at your 2024 tax return. And why are they looking? To figure out what you're going to pay for Medicare. And just to be clear, this isn't some weird loophole or mistake. It's literally how the system is designed. There is always a 2-year look back. So the money you made 2 years ago directly impacts what you pay for Medicare today. Wild, right? So what exactly is this surprise bill? Well, it has a name, and it's time to meet the villain of our little story. Its name is IRMAA. IRMA. It sounds complicated. It stands for Income-Related Monthly Adjustment Amount. Whew. But here's what it really is. It's just an extra fee. A surcharge that folks with higher incomes have to pay for Medicare Part B and Part D. Basically, the more money you make, the more you pay for your coverage. Simple as that. Let's put some real numbers on this because this is where it gets real. Let's say you're a married couple. In 2024, if your income goes just $1 over $218,000, boom. In 2026, you're each paying an extra $95.70 a month per person. That's over $2,200 a year extra for the two of you. And believe me, it goes up fast from there. Okay, so let's connect these dots. How does a one-time event, selling your house, suddenly turn into a monthly bill 2 years later? Let's break it down. Right? This is the key question. How does a single payday from your home sale result in a recurring charge month after month for a whole year, all happening 2 years in the future? It seems weird, but there's a reason. The whole secret is in a little thing called your Modified Adjusted Gross Income. You'll see it as MAGI or MAGI. Now, this isn't just what you earn at your job. It's a special number the government calculates. They start with the AGI, the Adjusted Gross Income from your tax return, and then they add a few things back into the mix. So what kind of things get added back in? Well, stuff like tax-free interest you might get from municipal bonds, for example, or interest from certain U.S. savings bonds. The whole idea is to get a bigger, more complete picture of all the money you have coming in. Okay, here it is, the absolute key to this whole thing. If the profit you make from selling your home is over that tax-free limit, the 250K or 500K, that extra money, the part that's left over, is considered a taxable capital gain. That gain goes right onto your tax return, which pumps up your AGI. This creates a big one-time spike in your income for that year. And that spike, that's the red flag the Social Security Administration sees 2 years later, and that's what triggers those IRMAA surcharges. See how it all connects? But hey, it's not all doom and gloom. The good news is, if you know this is a possibility, you can actually plan for it. So let's talk about a few strategies you can use to manage your income in the same year you sell your house. Okay, so what can you actually do? Well, in that same year you sell, you could try to max out your contributions to something like a 401k. That directly lowers your AGI. Or, if you're over 70 and a half and feeling generous, you can donate directly from your IRA. That's called a qualified charitable distribution. Another smart move is tax loss harvesting. That just means selling some other investments that have lost money to cancel out some of the gain from your house. Any of these could be enough to nudge your income back under those IMAA cliffs. Okay, but what if you're listening to this and thinking, oh no, I already sold my house? What if you didn't plan ahead and that big income spike is already a done deal? Don't panic. There's actually a safety net. This happens all the time, right? The sale created this huge one-time bump in your income, but your normal day-to-day income is way lower. So, does the government have a way to handle that? Yes. The answer is yes. You can actually appeal an IRMAA charge if you've had what they call a life-changing event. And that covers things you'd expect, like the death of a spouse, a divorce, or, and this is a big one, a major drop in your income, like when you retire. So here it is, the final, most important takeaway. If you get hit with an IRMAA charge and you know that the income they're looking at from 2 years ago is not what your finances look like today, you can fight it. You file Form SSA 44. It's a request for redetermination. It's your way of saying, hey, my situation has changed. So the real question I want to leave you with is this. When you're making these big financial moves, are you thinking about the ripples, the financial echoes they're going to create 2 years down the line?